Welcome back to the Thinking Crypto podcast, your home for cryptocurrency news and interviews. With me today is Greg Dickerson, who's a real estate developer, investor, coach, mentor, and entrepreneur. Greg, great to have you back on the show.
Hey, Tony, thanks for having me back. Good to see you.
Well, Greg, you're the man to talk to. We've been talking about the Fed, inflation, the crypto market, stocks, real estate for months. And today we got the updated CPI numbers. Inflation not as high as expected, but still very high. But the markets are seeing a bit of a bump from that. What is your take on the situation?
Algorithmic, trading metrics. So that was programmed in. If inflation came in at a certain percentage, markets would do X. If it came in lower, it would do exponential X. If it came in higher, it would do exponential X to the downside. So, this is all algorithmic trading, short covering. So there's a couple of interesting things that we can look at when we start talking about it. But really, the conversation now is there's a couple of debates going on. So one is, has inflation peaked? And if inflation has peaked, has it plateaued? Or are we going to see a reversal? So, that's the conversation now. That's the debate now. We won't know that till we get, numbers next month and we can kind of see how things are going. We know gas prices have come down. We've seen some relief in other areas, but like you said, inflation is still running very, very high. It's really hurting a lot of people. And for the government to come out and celebrate and say, oh, we had zero inflation last month it's just ridiculous to have those conversations. What you want to listen to and who you should be listening to is the Fed. So Neil Kashkari is out today, and Larry Summers and Evans at a conference, and that's on YouTube. People can look it up. And they're saying, look, we're not done yet. We're nowhere near done. We're going to see Fed funds at almost 4% by the end of the year, 4.3 next year. We're not stopping the rate hikes. We're going to continue on this path. We're not worried about a recession. That's not going to stop us. So, the next debate is it going to be 50 basis points or 75 basis points? And they're going to wait to see what the September numbers look like, and they'll have their meeting right after that. So, right now, we just don't know what they're going to do. They're going to base it, the higher inflation comes in, the more aggressive they'll be. If it comes in softer, then maybe they'll do 50 basis points. They're certainly not going to do 25. They're certainly not going to stop. They're not going to pivot, which was the conversation after Chair Powell kind of went off script after the last Fed meeting and said, we've achieved neutral. That sent a signal to the markets that, Fed pivot, we're stopping. And that's not what they said. Everybody walked it back after that, and the market started to unwind and unpack that. And so that's what we're looking at now. We're kind of looking at the Fed is saying, look, we're going to keep going. Inflation is still a problem. We're going to get it down to 2%. We're not stopping rate hikes till we get to 2%. They're not talking about QT. They're not talking about unloading the balance sheet, but the strong jobs report, if inflation starts coming down, that gives them more confidence to continue to roll off the balance sheet. And then the third thing to look at is the bond market. The bond market is still telling you there's risk of recession out there and to be cautious. So those are the things you really want to watch. What's the Fed doing? What's the bonds telling you? And then play the ranges in equities, because that's what they're doing right now. We're not going to see a market reversal right now, new all-time highs, but we're certainly going to see some very attractive ranges to trade in.
So are those kind of like relief rallies, those ranges? You have a little run up, you can swing trade it, but we're still in the bear market. We're not going to new all-time highs.
Yeah, we're still in the bear market. We still have recession risk. The Fed's not pivoting. They're not stopping. You need two things to put a floor. So we might be figuring out a bottom or a floor range. So we're going to test these recent lows to see if that holds. We're definitely going to do that again. So, well, nothing is for certain, but most likely we will retest the lows that were put in June to see if they'll hold. If they do, then now we can say, hey, we've got a market bottom, but until inflation comes down. So the markets can't bottom till inflation is peaked and starts coming down. If it plateaus, it's going to be hard to find a bottom in the market. But if it starts to come down and we've peaked, then we can start talking about a bottom. You can look at market reversal and new all-time highs when the Fed pivots. That's when you're going to get bull market back on. So until then, we're in a bear ranging market. So I say bear ranging because, again, if we can get inflation coming down, we can now find a plateau and a bottom. We can find a peak, plateau or decline in inflation. We can find the bottom in the markets and start looking for a reversal. And, if you want, I can share my chart if you
Sure.
engage that, and I'll show you something that's interesting about bear market rallies now compared to what we saw in 2009. As we know, crypto tracks traditional markets. This is Bitcoin on the hourly starting to unwind and give back that little pump that we had today. So, definitely hedge funds out there having a good time with everybody. But
Mm.
let's put this on the weekly and let's look at the Dow. And let's look at the S&P. So if you look at the S&P, we had this little pop here off of these lows of about, somewhere around 15%, right? Plus or minus. The interesting thing is here's the peak back in January of 2022 to now has been 31 weeks. Okay. And this happened in all three indexes in 2009. So here's the 2009 bear market. And the first rally right here, bear market rally of significance, was 14%. We're at 15 now. And it occurred exactly 32 weeks from the peak. We're at week 30, 31. So it's repeating this exact pattern in all three indexes right now. So it'll be interesting to see if this starts to decline at week 31, 32, 33, just like it did in 2009. So this is with the Dow, the S&P, the NASDAQ, and pretty much all major cap stocks. You can see pretty much the exact same bear market rally within 1% in the exact same time frame from peak to where we are right now in this rally. So really, really interesting stuff to look at.
Wow. And this is kind of, it's not tangible. It's kind of speculating, but midterm elections coming up. Do you think the president, and we've seen presidents sometimes use the Fed as a tool or weapon, if you want to call it that. Do you think they pressure the Fed to halt raising rates, but maybe after the elections they start raising again?
Not for this midterm coming up this fall. No, the Fed has to do what they have to do to get inflation down. The president can't stop that. During their election cycle, the perfect storm is get inflation down, even if it puts the market into, the economy into a recession, even if the markets are destroyed, get inflation down, because then the Fed can pivot, pump the markets back up, juice the economy going into the elections in 2024. Midterms, they've already lost. There's no point in messing with that. And they can't pivot. They can't stop. They have got to get inflation down. Because like you said, even at 8.5%, that's bad. That is still very punitive to people. And that's the biggest issue on people's minds out there. And everybody's kind of shaking their head going, what are you talking about? 8.5 and you're celebrating? That's not going to win them any points.
Yeah, for sure. I wonder if you could tell us what you see for Bitcoin and maybe Ethereum next on the charts. Maybe it's very similar to what you just showed with the stock market.
Yeah. So, so here's one thing about Bitcoin. So I'm really optimistic about Bitcoin now, more so than ever, because of the BlackRock Coinbase situation. So I'm sure you saw the news. A lot of people have been following the news that BlackRock has partnered with Coinbase as a administrator. So, not partnered, like literally bought into the company, but they've chosen Coinbase as a vendor to service their institutional clients along with their platform that they have, because they have institutional clients. They haven't said which ones that want allocation to the space. They want exposure to Bitcoin, spot Bitcoin. They don't want instruments. They don't want ETF. They want spot Bitcoin. So that's very good news for Bitcoin. That means that once you get institutional investors, and let's just think about BlackRock themselves, $10 trillion. Well, they're down to 8 now. They took a little hit here this year.
Yeah.
But you're talking about institutional investors around the world, $100 trillion worth of investable capital. But let's just take BlackRock and say they have $8 trillion assets under management. Let's say $5 trillion of that is institutional clients that want exposure and they invest 1% of that. You're talking $50 billion flowing into the space. It's going to be done over counter. So, but it's still going to affect the price because of the liquidity of the asset and the scarcity of the asset. So, you're instantly adding 50 billion, within a short period of time to the market cap of Bitcoin. So that's very encouraging, for Bitcoin, but we have to get there. That's not going to happen this year. Maybe Q1 of next year, you'll start to see this. But it's going to take time to get all this set up, get the paperwork done, get all the legal boxes checked, get everybody on board to what how much they're going to expose and allocate and things like that. But what I'm looking at again, we put that 17.5, 17.9, depending on which exchange bottom in, and we've been trending up. Bitcoin's been trending up. This is the hourly with higher highs, higher lows, pretty much on every time frame, hourly, 4-hour, and daily. But here the last couple of days, we're trending back with lower highs. So we have to really watch that and see, what Bitcoin's going to do. And, I think it's going to work its way back down, especially once the sugar high of the CPI print is over and everybody realizes and remembers that the Fed's not going anywhere. They're more resolved than ever. The harder the market bounces, the more tougher the Fed's going to be. They don't want to see this right now. They want markets down. They want, assets to, deflate. So it shows that they're doing their job and they can slow, demand a little bit and get inflation back down. But I think we're going to come back down, test this range. And ultimately, if that holds, which sounds silly, if that holds, then, we can start talking about a bottom. But we have to see inflation under control, and we have to see the Fed telling us that we feel comfortable that inflation is under control. That's a Fed pivot.
Do you think Bitcoin will, within this small range here, top out about 28,000, or do you think it doesn't even make it there and then just rolls over to the lower?
Yeah, it hadn't been able to get past 24/7, right? It hadn't been able to get to 25 yet. So I think that's your cap right now. And more specifically around 24,000. Of course, this is the daily closes 23.8. So it hasn't even closed at 24 yet on the daily, but it's wicking, and testing those 25K levels. That seems to be about it for right now. And it looks like it wants to, again, trend back down and test the bottom here. Now, Ethereum is different. So Ethereum, with the ETH merge, there's a lot of speculation going on there, a lot of hype and activity going there. But once the merge happens, you'll see the classic sell-off and ETH will go back down and test these lows again, just like, pretty much everything else. And it's the same thing the markets are doing. The markets, traditional markets, let's take a look at the NASDAQ. NASDAQ had a nice little bounce here, but still nothing. This doesn't compare, I think, to the 2000, definitely not the 2001 bounce and 2000 bounce, and definitely not 2009. But it's kind of doing the same thing where it was working its way back down until the CPI print. And if we'd have got a higher CPI print, markets would have sold off today. And again, it's just the algorithmic formulas that are programmed in the hedge funds. They're trying to make up for a lot of lost ground this year. So you can see a lot of volatility. How did they make up for lost ground? They got to dip back to these lows. They're not making any money with this market moving up like this. They needed to come back down, move up, come back down, and kind of retest these lows. Just like we did, back in June. Not quite back to that level, but I think we're definitely going to revisit that here pretty soon.
You mentioned Ethereum, obviously with the merge coming up, in a little different scenario, a little bit of a hype around that. Think it makes it to 2,500, or it's probably going to roll over with Bitcoin. We've seen alts move with Bitcoin.
So, well, ETH's broken free. So ETH is testing new higher high levels that Bitcoin has not been able to break through. When you look at Fibonacci levels and stuff, so I don't know where the limit to ETH is. It just keeps breaking to new highs. Here's 1,900 here. There's 2,000. I mean, I could easily see it jumping back and testing 2,100 again.
Gotcha.
With the momentum it has right now. So if the momentum sustains and, you get more hype and everybody buying into the ETH merge, it makes sense for it to come back and test this level. And if you look at a fib, from this recent high here, I mean, it hasn't even retraced 50%. So 50% would get you back to that $2,200 level. So that's definitely possible.
Gotcha. Now, you mentioned the BlackRock news, and I'm wondering if your approach has changed in that you have primarily been a trader, a swing trader. Are you going to take any hodl positions given the BlackRock news?
Yeah, so I'm not a hold on forever and always through anything. So I trade the ranges. So I'll be longer term at that point. So once we get news of allocation, Bitcoin has retested those lows, and I feel relatively confident that we've put at least some sort of a macro low in here for a period of time. I would feel better about going in here and trending up with the market. Right now, I feel like there's still downside risk. There's still potential because we have recession, we have inflation. So let's take that out of the equation because I don't think they're going to allocate until we get those things off the table. I don't think they're allocating in this environment. They want to see inflation on the way down, if not leveling off. They're going to want to see recession off the table before they start allocating to these types of risk assets. So once they're in, that means that stuff's been cured. So yeah, at that point, I'm ready to go more long term, but I'm still going to sell at the top and buy at the bottom because when you do, you just do the math. If you sell here, and just buy here, and then sell here, and then buy here and sell, I mean, you're tripling your portfolio to ride back up again. So you always want to, sell the rips and buy the dips. But, if you go back to a scenario like we had here, knowing what happened here and what can happen again, I would definitely take a longer term trade if this 17.9 holds and see if it'll get back to that 60 to 100,000 range. But I'm gonna have a hard time not selling at 60 to 70,000 if I'm in down here at 17 for a longer term run. And I'll have a hard time selling because it's not going to be a straight line. It'll be kind of like this where you'll get some opportunities to get in and get out. So if I see some declines coming, I'll be inclined to sell and try to buy on these retracement levels. And that's hard to do, so sometimes it's better to just buy on a longer term bullish trend and just kind of wait until you see a macro change. But yeah, I will definitely be longer term for whatever cycle we're in for that range. Once I know BlackRock's in, they're allocating. And so the other thing I was going to say is, can you lose money if you buy right here? So the thesis and Michael Saylor and everybody says anybody who's held Bitcoin for 5 years never lost any money. Okay, well, if you bought right here, that's 2021. Here we are 18 months later. If we don't get back here anytime soon, 5 years comes and goes pretty quick. So I feel pretty good anywhere in this range. And I'm not saying buy Bitcoin. I'm not saying don't buy it, or Ethereum. Ethereum's different. There's a lot more risk to Ethereum, even still with the merge, than there is Bitcoin. I think Bitcoin is your safest crypto asset right now, given the environment. I don't think you can lose money in the long run if you buy Bitcoin here. I think if Bitcoin went down to 1,000 or 3,000 or 5,000, I think you're pretty safe that it'll get back to 25. I don't know for sure it'll get back to 40. I don't know for sure it'll get back to 60. But I feel pretty comfortable that if I bought here in the 17 to 25,000 range, if it did dip, it will come back, and I'd be able to get out before any long-term bear market potential downside for Bitcoin. So I don't think you can lose money buying here. I just don't know what or how much of an exponential upside you're going to have from here, because a lot of people are going to sell when it gets to 40. A lot of people are going to sell when it gets to 50. A lot of people are going to sell when it gets to 60.
Yeah. I was talking to Garrett Soloway just last week, and he's saying there's more downside to come, and he's looking at a $12,000 to $14,000 Bitcoin. We don't know if that's going to happen, but there's certainly the risk of it, certainly occurring.
Yeah, but it'll come back. So again, it always gives you a chance to get back out. If you go back and get back in, get back out. If you go back and look and you bought here and it dropped all the way down, I mean, you had another chance to get out. Same thing here. You bought here, it popped, dropped back down. You get chances. We haven't gotten any chances, above these levels right now. And, these bear markets can last a lot longer than people think. They can go a lot lower. And there is a lot of technical confluence to get back to those, 14.5 to 15,000 levels. When you start looking at, the 200-week moving average, where we're at right now, struggling to kind of maintain that. When you look at, the historical markers and things like that, if we can't maintain the 200-week, then it probably will. If this 17 breaks, it probably will go down and test that, because that's your next level of major market support. And if it breaks that, then you're probably looking at that 10,000 again. And it was just a year and a half ago, it went down to 4,200, about $4,000, depending on the exchange, back in March of 2020. So it can get there if something happens in the economy. So if it does, I have no doubt it can get back to this level. Can it go beyond? I don't know until it does. So this could be a top of a range for a little while, for all we know. But if you get, like I said, if you get institutional capital in like BlackRock, and they're bringing 50, $100 billion to the space Q1 next year. You should see $40,000, $50,000 Bitcoin when that happens.
Mm. Um, let's talk about.
Unless that happens at 5,000.
Oh,
If
yeah,
Bitcoin's down at 5,000 or 10,000, then it's going to get you back here, and that's about it.
for sure. Yeah, I mean, personally, I see this as an accumulation zone. I know we could go lower, so I'm buying in small increments. And I'm not I'm more of a long term, but if it does rip up to 40K, I'll certainly be taking some profits, but I still have my long term hold bag. Um,
Yeah, and I just don't operate that way. I mean, I don't maybe it just hasn't been my thesis and my business model over the years. I build and sell, I buy and sell. I don't really hold anything long term, and that's worked for me. Now I have a lot of people I work with that never sell anything, and I have people that are in between. So, whatever works for you and your structure. And I've been the same way with stocks. The last biggest moves I made in stocks were the bottom of 2020 and the bottom of 2009. And I sold a lot of those. And, if I'd have held a lot of the stocks I had back from 2009, if I'd have bought Bitcoin back then and held it, I mean, I'd be in great shape, but you just don't know what the future is going to hold. And I have financial goals and I had targets that I wanted to hit, and I hit those. So I'm fine with that. And, I'm in a different stage in life where I'm looking at capital preservation.
mm,
I just, as safe as Bitcoin is right now, and with institutional capital coming in, it's still only 11 years old, 12 years old. It's still a technology. It's still an emerging technology. So there's no guarantees.
yeah,
And there isn't with anything. I mean, even when you're investing in equities and things like that, I mean, really the only safe guarantees out there are basically treasuries, backed by the U.S. government. And, as long as the government's functioning, you're okay there, but there's no guarantees there either, right?
sure. Yeah, yeah. I think I'm more in the middle. Certainly take profits. So I'm meeting my financial goals, but still holding some long term. But if things do get tight, depending on financial situations, I will certainly be selling, to get
Well, and
cash.
that's smart, so you take your profits, you pull your basis out and you roll with so that's two things. One, you can leave an amount and just take profits, or two, you can take your basis out and then roll with the profits. And then you can pull a little bit off the table, as you go along. So there's a lot of different ways to do it. Dollar cost averaging, that can work for some people. If you bought right here and you want to reduce your basis as you go down, I mean, that's a good way to do it if you're a long-term holder. But me, I would rather sell here, buy more here, sell here, buy more here, sell here. But that's hard to do. You got to pay attention. You got to be ready. And, you have to be willing to wait for these ranges. But like I said, if you're trying to do that and, you're selling here and you're buying back here and you sell right here and, I mean, it's giving you multiple chances to get in and get out if you miss. So, if you bought down or if you bought here thinking it was going to continue on and it drops, it comes back and it drops and it comes back. So you generally get chances until you don't, but at least, when that market bottoms and you give it a couple, 2-3 days to kind of confirm that bottom, or a week, you can feel kind of confident that it's definitely going to get back. And like I said, I think in this range, I don't think you can potentially lose. There's no guarantees, but I don't think you can potentially lose long-term buying at 17.5 to 25, even if it goes down to $5,000 or $10,000, because it's just not going to stay there. There's just too many people aware of the asset now. There's too many people that are going to be buying. And right now, there's been too many buyers to even let it get below 17.5. So, we'll see if it can break that level. And if it does, then it's going to visit 14, 15.5, because that's your next support. But I don't know. That's going to be a tough level to break, I think.
For sure. Let's talk about real estate and how things are doing there. I'm looking on Zillow. I see some house prices getting cut. It seems to be a lot of inventory right now. What are your thoughts and outlook on? And I know it's hyper local, but generally
It is, but really it's interest rates. So at the end of the day, interest rates have doubled. They're still double what they were 6 months ago. And that did start to cool the markets when rates were above 6%. But rates have dropped back down a little bit. So you've seen some refinance activity spurring. You've seen buyers that are still out there. And, again, depending on your market and how much inventory you have, that's going to determine the degree of price cuts, inventory stacking, things like that. The other thing that kind of skews it is the summer is always slower anyways. July and August are your two slowest months generally in the housing market. So that's kind of going to skew things. But we are seeing inventory levels rise in most markets. We're seeing prices adjust in most markets. We're seeing properties sell under asking price in a lot of markets. And the biggest hits right now are being taken by the builders. So the builders are, I mean, it's crickets for the builders. Their traffic is down, if not gone completely. So builders that have inventory, they're cutting prices and offering deals and discounts to get rid of inventory. So that's where the best deals are right now is with new home builders. Then you're going to see coastal markets, second home. You're going to see that market start to take a hit, take a beating, especially once we get COVID completely off the mind and behind us. The further we get away from a COVID mindset, the more you'll see those markets start to take a hit because people are just kind of over it. They're done. They don't need it anymore. And, they're going to try to cash in on this, market right now while it's still relatively robust in a lot of areas.
Yeah. And the other thing I was watching too, but I don't know if this is something that you pay attention to, but is the car market and those respective prices and also rates around that. And do you pay attention to any of that by any chance?
Yeah. And that's interesting because the car market, I think, has the biggest risk out there from an asset area where you're going to see a lot of defaults, strategic defaults. So like we saw in the housing market, I mean, this isn't going to affect the economy like the housing market did, obviously, because there's not that much tied up in it, but there's enough to where, it can create some issues in the car market. We're seeing prices come down in some areas for some things. We're seeing prices go up, for some vehicles and some product, but used cars are coming down. The auctions are stacking up because they're not getting the buyers because the dealers overpaid. You're seeing a lot of that, but the credit defaults are starting to happen because a lot of people bought these vehicles during the pandemic with the stimulus and, those types of things. With inflation, that's put a dent in everybody's pocketbook. So that $1,000 car payment that, they could afford 2-3 months ago, they can't afford now because of gas and food and just everything else that's gone up. So what people are doing is they're going and they're buying a new car with, a less payment. They're trading down and they're just turning in the old car and just giving it back and defaulting. So you're seeing the strategic default in cars now, like you saw in houses back in 08 and 09. It's pretty interesting.
Lots of things to pay attention to. Greg, thank you so much. Always a wealth of information, and appreciate you joining me today.
Yeah, thanks for having me. I'll see you on the next one.